Let's do one thing. Venugopal Garre, who's the managing director at Bernstein, joins us now. We have a minute to go before the market opens. So let me get a quick comment in from him. Venugopal, thanks for being with us. Do you think this market is getting into a phase where some caution is needed?
No, that's right. Given that the market is just about to open, firstly, Happy New Year to all of you. Yes, my broad, quick answer to that would be that we are probably reaching a situation where we're hitting onto a valuation ceiling. Look, this has nothing to do with being negative on macro or on earnings. It is primarily a situation where we are actually calling to take profits. That's basically what we've been arguing in our Outlook report as well.
Venugopal Garre, Managing Director at Bernstein, is with us. Venugopal, thank you very much for joining in. Season's greetings to you and wish you a very, very happy new year. Now, you are calling for a bit of sobriety, right? I think you're looking at 8% return this year, and you're saying, you're telling clients book profits. Tell us why. Why the caution? Is it simply because of the run-up that we've seen, a very strong run-up in the last 2 months? Or do you see any other risks or red flags out there?
Yeah, so I think this book profit call is clearly not consensus. The fact that even after releasing this report on Jan 1st, I've had conversations with quite a few investors. I don't think investors at this juncture are too worried about both the macro and the earnings landscape. But the reality is that the fact that everybody across the board is struggling to figure out how to eke out decent size returns on India at this juncture. Now, interestingly, this is not just a challenge that portfolio managers are finding. This is a challenge which even analysts would find both across sell and buy side, and in terms of a struggle to see how to increase their target prices. So believe me, you'll see a lot of creativity out this year in terms of trying to figure out how to generate more returns. But the reality is that valuation ceiling is fairly intense. Now, if you were to think about it, earnings growth this year is fairly decent. Broadly a mid-teens clip for the headline indices and probably higher for SMIDs. But the reality is that, are we going to see earnings upgrade this year, especially in a year where macro is decent, but not necessarily going to see an incremental positive momentum compared to what we saw last year, because last year was on a low base, right? So we swiftly moved up and quite rapidly moved up. So earnings upgrade cycle doesn't look like the case at this juncture. Decent earnings though. The second thing is primarily that if I were to look at it, a lot of the positives, especially around the rate cuts, which are expected this year, both from a US perspective as well as potentially from India. We're also seeing a situation where broadly there is a political certainty expected, and especially after the news flow post the state election results. That's also something which is priced in. So these are the positives, which essentially in our view are priced in. See, purely very quickly from a risk standpoint, the reality is that risks don't really announce themselves. They keep looming around somewhere. You just need to figure out whether those risks basically translate into a reality. For me, the simple things primarily are that a premature interest rate cut, in my view, would be a mistake. And that's primarily because it's going to revive inflation fairly quickly. And this I'm talking about global perspective. India's rate cycle cannot create any inflation. It's basically about what happens in the world. So that is something I would worry about. Number two, El Nino is still a risk from a point of view of monsoons and what it does to rural sort of economy. Number three, primarily would be the fact that US, there is still a lack of clarity on where they head in terms of economy. Now, if there is a rude shock or a sort of a really big shock out there, that's sort of something which is not priced in. More importantly, there are wars going on. We don't know what happens to that, but these are like the outer cases. So there are some of these sort of macro global risks which are looming around, which we need to acknowledge.
Okay, hi Venu, good morning and good to see you. When we take your caution on board, but let's talk about a couple of sectors that did very, very well in the last 12 to 18 months. The power sector, that's done very well. The question is, you all got it right on the upside. Stocks like NDPC and all have done well. What do you do from here? Will you take some money off the table, or do you believe India's economic growth is going to be there? Power consumption is going to be the need of the hour. And that's why you continue to hold on to these stocks, because valuation-wise, some of them are still not very, very expensive.
Yeah, so in this entire construct of India call, remember that everybody is running a fund where they need to have positions, right? So it's all a question of how do you actually outperform a Nifty, which may not generate much returns. Number two is return expectations should be lower across the board, even if you pick stocks. But this is the year of bottom-up stock picking. Now, in that construct, since you mentioned about utilities and stocks particularly, now the reality is, yes, this is an election year. However, you need to, of course, ensure there are not too much of cuts, right? Especially in heading into elections. And more importantly, there's a shortage going on. So these are fundamental underlying drivers which are going to lead to ordering, right? Doesn't lead to earnings growth suddenly for especially those which are regulated utilities, don't have a merchant exposure. Probably merchant prices might still remain high for a while. So in that construct, you are aware of these potential possibilities, which are the earnings drivers. Part of that is, of course, modeled. So the reality is that stocks have also moved up. They've more than doubled, probably gone up even more than that in the last 12 to 18 months, reflecting the reality. We would be selective even in the utility sector. But some of the ones that we still have in the India portfolio are, one of the largest government-owned utility. It still looks okay. We're just still scraping through some return potential out there. So be selective even there, pick some stocks. But I would still say be careful about governance. Utilities, you need to be careful about governance, especially in some of the stocks where there could be challenges. So stick to some of the safer names, which may not give you those sudden, random risks.
Got it. Venugopal, just to understand how to position one's portfolio, right? Is there a higher propensity for a downside in the mid and small cap space compared to the large caps this year? And would you recommend taking positions out of the broader markets first rather than the large caps?
Yeah, so we actually were big proponents of small and mid caps last year, all through the year. We gave special allocations to SMID, but I have given up right now. So what it means is I'm unable to justify valuations. Two quick things that we look at is implied earnings growth for mid caps over a very longer period. When I say earnings growth is basically typically free cash growth, that's about 18% over the next 15 years. Of course, it's not possible to generate that, which means mid caps, of course, are trading above fair value at this juncture. That's a fundamental issue. Number two is mid caps in general and even small caps relative to Nifty index are trading at their historic peak in terms of valuation sort of numbers. So what it means is that it probably makes sense to take profit in SMID caps. And that's the reason why we have turned an underweight on SMIDs. We haven't turned underweight on Nifty, but we have turned underweight on SMID. So that's the area where we're actually wanting to take profits. We want to be still safe and nimble through the year, of course. So that's why we prefer running with a few large caps. But remember, this is still going to be very bottom up here and there in terms of what we believe there is still potential for earnings to be decent or some upside risks and things like that. And where valuations are relatively okay compared to history.
Okay. Just telling our viewers, if you're wondering, SMID, that's small and mid caps. So that's the new acronym given the absolutely heady rally of 2023 in the SMID space. For the benefit of our viewers, Venugopal, just coming to you, but for our viewers, I just want to point out a lot of the very interesting calls, and many of them are anti-consensus calls that Bernstein has put out. Of course, one is the downgrade of the small and mid cap space itself, but on sectors, they're overweight on financials, which is fine. So is, a large section of the market. Bernstein has upgraded IT services to an overweight, and they've downgraded consumer technology to an equal weight. They've upgraded telecom to an overweight, upgraded metals to an equal weight, and they're retaining their overweight in healthcare. And very interestingly, there's a downgrade on real estate and cement to equal weight. And in consumer and industrials and utilities, Venugopal's team is saying stay focused on very selective ideas. Very interesting calls, Venugopal. And I want to start off with IT because financials is fine. I think, we've been discussing that with a lot of experts, the expected upcycle in banks and financials. But IT, what makes you optimistic on IT services now, given the patchy record and, the very lackluster numbers that we've seen, growth numbers from these companies, and you've downgraded consumer tech. And actually, that is where the numbers over the last couple of quarters have started looking better in terms of profitability and break even. So run us through the thought process here.
Yes, so you're right. This is a non-consensus call, and usually non-consensus calls are very tough to make. So I'll tell you the thinking around this. We wanted safety, number one, which was primarily centered around spaces which were large caps. So remember, consumer tech is usually SMIDish compared to IT, which is large caps in general, especially some of the larger names. With decent balance sheets, free cash flows with potential for buybacks, so you always have that downside protection. Remember, one of the other things that we are not really saying that you're going to be heading into a sudden U-turn for numbers. In fact, as we head into this quarter, we're fully aware that the numbers that are going to come out are not good, right? And I think even guidances might be tweaked and things. But the reality is that we're thinking that we are in a situation for this particular sector where an earnings downgrade cycle to a large extent has played out, and we're probably scraping the bottom, and hence there is very limited interest in this sector at this juncture. So this is not an over-owned sector from that perspective, right? And more importantly, valuations have come down from historic peaks to below averages at this juncture. So there's a huge comfort around this aspect. So when these companies report bad numbers, it would not surprise you. Say, okay, fine, we were expecting this to be bad in any case. So these are like signs of bottoming that we see for this particular sector. Number two, also remember that the broader thinking at this juncture, which has not been, say, we are not building a US stock in our model, right? If we were building a US stock, I would have been technically underweight Nifty and called for a 20% downside, right? I'm not even saying that. So the reality is, if we're going to see these first rate upticks, what is the thinking people have in mind? They would have in mind, they say US probably will come back on a growth sense. Yes, that will impact inflation later and impact India, but that's like the second order impact. So this sector plays into that, right? And that is the whole idea with which saying that, look, it's not really about near-term momentum. This is basically about this particular paradigm as to why we wanted to take this non-consensus call.
Venugopal, what about this entire financialization, digitization theme? In India, that's really come to the fore, right? And there's been plenty of interest on that front. Will you still be looking to play that theme? If yes, how do you play that? We have discussed this in the past as well, that that's something that's made India stand out actually, and that was offering big potential. How much has played out?
Yeah. So look, this is consumer tech is a 10-15-year theme. Right? So I don't think that theme will go away. And so is the case with India. India is a 10-15-year theme. That's not going to go anywhere, right? See, but the reality is we've had some successes last year in consumer tech in terms of one particular theme I was playing, which was basically a loss to a break-even theme. Now, if you look at most of the consumer tech companies, they've actually moved from a loss to a break-even to a marginal profit, right? So to a large extent, quite a few of the frontline stock that we used to like have actually played out. And that is the reason we prefer booking profits. Number two is that the journey from here is still there, but it is not going to be as swift and previous year. So that is the other the other thought process that we have. Number three, you would see a swath of IPOs. Low quality IPOs, which will come out who are trying to time spoil the image of the consumer tech sector again. So remember this aspect. So the entire sector basically primarily we've turned to an equal weight on consumer tech rather than turning underweight at this juncture, right? So we would the reality of why we decided to shift. This is not a 10-year call. This is basically about now.
And that a little bit more. Is this a multi-year call? Is this a structural up move? Because, that is one space that didn't...
I never look at metals from a structural perspective ever. So it is all about taking those opportunities for that last year and the year before as well. I went into an underweight on metals 2 years back. Both expectation of consensus looks wrong. I think that looks fairly okay. And that is basically about flow of money as long as you're comfortable with the fact that there's going to be no further earnings downgrades. Complete done at this juncture. I'm not even taking a 1-year call on metals, honestly.
All right, Venugopal, thanks so much for stopping by, giving us, that view on the market, sounding a little bit cautious, and maybe for good reason. This longer-term story is definitely intact for India, but maybe in the near term, taking some money off the table may not be such a bad thing. Thanks so much for joining and giving us that view.